Hello and welcome to the DIY Investing YouTube channel. We are going through every company in the S&P 500 and today is Anthem Incorporated, ticker ANTM. Over the next 5 minutes, I'll go over both the business valuation for this company and what I think of the business quality. So let's dive on in. First thing is industry. This is a healthcare provider and services industry. So if we go into the business description, they provide a health benefits within the United States as 4 segments: commercial specialty, government, business, and prescriptions. So network-based managed care solutions, health benefit plans. So they are providing, it seems like a health insurance provider. Anthem is a health insurance provider within the United States. Beta and share term don't really tell us much, but return on equity. So immediately when we look at this return on equity chart, we can tell a few things. One, the return on equity is both very good and fairly stable. You have 20 straight years with no losses because there's no negative return on equity. So that's a very positive sign for the quality of the business. In addition, you see this 10% line. In only 1 year in the last 20 years was the return on equity lower than 10%. That's a very, very strong sign. You like to see those double-digit numbers. 15% is ideal, but anything above 10% is certainly worthwhile. And so only in 2004. But since 2005, we've been positive and above 10% that whole time. Very stable from 2010 to 2016, but since that time, we've been able to grow to a much higher return on equity in that 14 to 17% range. So looking very strong the last 5 years in particular. So I like what I see there. 10-year median return. So you see the return on assets of 5%, return on investment of 3.7%. So there is some leverage in this business model that's allowing you to grow to those double-digit returns on equity. Now the PE of 20. PE of 20 is pretty respectable. This is normal for high-quality companies, so everything I've seen so far suggests it's a high-quality company, so I don't mind this valuation. It's probably in the range of a fair value before we do a deeper dive, but I like what I'm seeing there. So revenue growth of 8.6% is both higher than premiums and assets. So that's actually pretty good because you're growing your premiums and revenue faster than you're growing your assets, which means that you're going to get some operating leverage in the business model. That means over time, your returns should get better and better. And that's what we've seen since 2016. The returns on equity have continued to improve because you've been growing your revenue faster than your assets. In addition, this is why your EPS has been going double digits. So even though you've had single digit revenue growth, you're growing double digits in EPS because you're getting that operating leverage. So very strong signs in terms of growth, very strong signs in terms of what shareholders are getting from this investment. You can see they're also growing dividends pretty reliably. Dividends were $1 per share at the beginning of the decade, and now they're at $4.52. So you 4x your dividends over that time frame. You've tripled your earnings. Very positive signs from what we see here. So let's go to our income statement. Income statement. The first thing I see is that your shares diluted have gone down over the decade, so they're continuously buying back shares. You really like to see this as an investor. It shows that the management team respects investors. They're buying back your shares, making them more valuable over time. Let's go back to the overview a second, see if we can get... So your underwriting margins, not super stable, so we don't have that. So balance sheet. So this is an insurance company, so it's a little difficult sometimes, but what you're going to see here is your future policy benefits, here are pretty stable around that $800 million number. You're growing your current liabilities, you're growing your debt, you're growing your retained earnings. It's going to be pretty straightforward that you're going to see this happen with an insurance company, is they're going to continuously be growing their liabilities to match up with it. So you can't tell a lot without a deeper dive into their actual filings. But we can see some things here. So stock-based compensation, they do pay stock-based compensation every year. I don't always like to see that. But what we can see is that their net issuance of common stock is negative. So they're buying back shares every year at basically a 10x the size of stock that they're distributing. So you're always buying back shares. They're making a good dent in always decreasing that shares over time. They're also basically continuously raising debt, is maintaining leverage on the business. It is an insurance company, that's pretty normal. In addition to buybacks, you are having some dividends, but you can see that buybacks dwarf the dividends to a significant degree. So you're getting more of your cash return from buybacks than you are from dividends, and that's okay. So everything here looks pretty good. Any other key ratios here to look at that I want to see? No, I really like what I see here. I think Anthem is clearly a good company in terms of what the metrics are showing us. This looks like a reasonable valuation, price to PE of 20. I like to pay less than 15, but I understand why you might be interested in this. With these growth rates, if they're sustained for another decade, then this is a pretty attractive evaluation. It does appear to be a high quality company. You have no losses over the last 20 years. There is some instability here as it's been able to jump up, and so you want to see, is this growth sustainable or not, or am I going to track back towards this 11% return on equity range? Either way, very attractive, high quality company, relatively good valuation. It's worth going on the watch list, or doing a further deep dive on Anthem. So this is Anthem, ticker ANTM. If you like what I've done here, hit that like button. Don't forget to subscribe, ring the bell so you get notifications about future videos. Thank you for listening. Until next time, stop paying fees, start building wealth.